Good afternoon, and thank you for joining us for today's webinar, where we'll take a look at the first quarter results and provide a little bit of an outlook. My name's Sean O'Brien. I am the president of QuickRate, and as always, I'm pleased to be joined by David Ruffin. David heads up our IntelliCredit division. David, I don't know if you want to go ahead and introduce yourself and say hello to everybody today.
Indeed, it's always a pleasure to join you, Sean, on these quarterly updates, and look forward to hearing what you say first.
Okay, appreciate it. Likewise. Just a reminder, we will be sending out a link to today's recording. We'll include a copy of the slides. We will have polling questions, so we'll include those as well. I think I've remembered everything this time, but if not, someone will certainly remind me in the chat or the Q&A. Oh, that's what I forgot. If you have a question, certainly submit them in the chat or the Q&A as we move forward. And again, just a reminder of the different products and services that QuickRate currently offers. So just a quick agenda, right? It's been kind of a quiet start to the year. We'll look at the QCBI results. David's going to provide a credit update and an outlook. And then we'll just end with some questions, and then certainly any updates that we have. So let's jump into the polling questions. I think we just have a few again. Always appreciate everyone's participation. The first one is just in response to, actually, I'm going to go this direction. First quarter concerns. What concerns you most after the first quarter? Rising deposit costs, deposits leaving your institution, credit quality, margin compression, or other? So we'll just give this 15 to 30 seconds or so. Okay, we'll go ahead and end this one. And we'll share the results. So margin compression kind of leads the way. Deposits and rising deposit costs and leaving your institution kind of neck and neck, and then credit quality. So thank you for participating. Let me go to the next question. Just kind of on budget. Are you currently ahead or behind your 2024 budget? Again, we'll just give this 15 to 30 seconds. I know for us at our small community bank in Illinois, we are slightly behind budget this year. Obviously, just like the previous question, deposit costs are up, and our loan growth has been a little bit behind where we were. So we'll go ahead and end this one. And we'll share those. So 40% are at budget, 31 ahead, and 29% below budget. So thank you again for participating. The next question has to do with deposits. Did your deposits increase or decrease in Q1? So, or stay the same, I guess. Always need to offer that answer as well. So this is encouraging. Go ahead and end this one. 49% of you saw your deposits increase. That's great to see. 32% decrease and 19% about the same. And let's move to the next question. Kind of the same idea with loans. Did your loans increase or decrease or stay the same in quarter one? Again, I think encouraging numbers from my perspective. 49% of you saw an increase, 20% decreased, and 30% stayed the same. So our final question just has to do with digital marketing. Do you currently conduct any digital marketing at your bank? Just a yes or no question there. Okay, great. 77% of you are, 23% are not. So let me share those results. So again, participate everybody joining in on the polling questions today. And as I mentioned, we will make those part of the email that we send out probably not tomorrow or maybe late tomorrow or the next on Thursday. I just thought we'd start with, so much of our, kind of water cooler talk and just, kind of a top of mind every day is kind of what's the Fed going to do? What's the Fed thinking? And again, it's hard to play the guessing game. And I just thought today we just share, kind of what the Fed members and the bank, the different regional presidents, kind of what their projections were. So this was from March. And you can see, right, you can understand why they are slow to move, right? Really, their median forecasts for the economy are kind of right where we are, right? The 2% GDP, unemployment rate staying strong or low, inflation coming down, not yet to 2%, but coming down, and the PCE inflation, which is a personal consumption expenditures measurement, different from the CPI, which is often the more headline measure. The PCE is really what the Fed is looking at, right? And that's looking at goods and services that consumers are buying, or households are buying, and that's where they're really focused on. And you can see, even based on these projections, it's coming down, but it's going to take us still into 25 or 26 before they really think it's going to get to 2%. And so, again, I think it kind of coincides with what we see. Fed funds rates not really moving yet, expectation that they will. But, as the Fed has continually indicated, if things change quicker, they'll adjust quicker. But right now, since inflation's not coming down as quickly as they'd like, they're going to keep things on hold. The second thing I thought we'd do is, again, just show the infamous dot plots. You hear a lot about, where the Fed, again, all the members and the presidents, they pick and make an indication where they think the target range should be for Fed funds over the next couple of years. Again, you can kind of see the majority of them, don't see much movement this year, a little bit more movement next year, but there's half of them who think we might get under 5. But again, we're really kind of stuck in this camp of a cut, maybe 2 cuts, outside thinking maybe 3 cuts now as the year goes on. But again, I just thought we'd share those, just try to I don't know, just kind of level set what the expectations are. And I think for all of us just to plan accordingly, that I think at some point there's good and bad, right? The economy continues to grow, albeit slowly. Inflation's still there, but it's slowly, the rate is slowly coming down. And I think at some point the economy is going to slow enough that it's going to need rate cuts. And for a lot of our consumers and customers, that'll be a good thing. And so I think certainly inflation has been the top of mind for the last year and a half or a couple of years. But again, I think it's the Fed is going to continue to move gradually as we go forward through the year. The other thing I thought we'd do differently, and we are working on some changes to our QCBI reports. We want to make them a little bit more granular, a little bit more detailed, maybe a bit more expansive than be just beyond the medians. And so we should have those ready for next quarter. But I thought for this quarter at least, we could just kind of look in aggregate kind of what's happened in the industry. So as consistent with the polling question, deposits on a quarter-to-quarter basis, these are not the annualized, it's just quarter-to-quarter. Deposits were up about 1%. Non-deposit liabilities actually were up over 3%, which I put that there just because I thought over quarter-to-quarter, that was actually a pretty significant move. Securities balances are up, loan balances are down, overall assets are down. Not surprisingly, cost of deposits continue to rise. Asset yields were unchanged to slightly lower. but overall liability costs continue to increase. And so I think these are all the things that, I think all of us are continuing to experience. And in turn, net interest income is down. Now, this one I thought was interesting. Non-interest expense is actually down. Part of that may be attributable to the fact that mortgage operations are a bit slower, but the non-interest expense was actually down overall for the industry. Net interest margin was again, unfortunately, down. Non-performing loans were up, and the charge-offs were just kind of steady from the previous quarter. And so again, I think we're gonna, like I said, hopefully by next quarter we'll have some additional ways to look at this quarterly data beyond the medians that we typically focus on. But at least today, I thought we'd share just what we saw exactly from quarter to quarter. Another thing that I've been thinking a lot about, and I think given what happened last year and the focus that uninsured deposits have played, I was just kind of curious, like what the level of uninsured deposits were in the industry, and so these were just some quick things that I searched quick analytics for, and over 2,700 banks have 20% of their deposits uninsured. You can see 232 banks actually have 50% of their deposits uninsured. So again, I think, as we think about what expectations examiners might have around our liquidity, being able to quickly plug an uninsured deposit, runoff, while certainly not as, doesn't feel quite as imminent as it did last year. I do think we should still continue to be sensitive to what these balances are in our bank, and make sure we have funding to potentially cover any immediate movement of these types of deposits. Because again, these are the most likely ones to move first. I would argue in some ways they're kind of under the in the radar or under the radar of other institutions and other fintechs. So again, I think just continuing to monitor these is probably in all of our best interests. And which leads me into, are we entering, a new normal for our deposits, right? I mean, I think we've talked about this a little bit before on previous quarterly summaries, but I just feel like where interest rates are and, and what Silicon Valley exposed and how quickly deposits can move, and with interest rates higher, that, our best depositors and our best deposits are going to likely remain, kind of under attack, if you will, from other financial institutions and fintechs, right? I mean, deposits are our lifeblood, for our industry. We need them to grow. We need them to be priced affordably for us to make a margin. But everybody wants them, right? And if you can't get them just from the overall industry growth, then you got to come take them probably from somebody else. And I think technology is really changing the way that this is going to happen. And so I think we have to ongoingly just continue to monitor our strategy and how we'll address protecting our deposits and trying to continue to grow our local deposits. I'm sure many of you employ any one of these different ideas, but again, I think it's just something that we're really going to have to continue to work at, because I just feel like there's never going to be a time where in the near future, right, where we relax about our deposit base, just because, again, if it's not another financial institution, it's the continuing increase or onslaught of new fintechs and private, kind of that shadow banking reemerging, right? We've seen it in mortgages. We see it more now in private credit, but everybody's coming for these deposits. And so just continuing to make sure we are staying in touch and contact with our best customers, I just think is going to be continually extremely important. So again, kind of what we see for the rest of the year, kind of the same thing, right? Fed funds staying stable, hopefully a decrease or two in, later in the year. The Fed's going to try to continue to reduce their balance sheet. I don't know how much luck they'll have. It'll be gradual. The economy is slowing. It's still positive, which is good. But the Fed's going to be on hold. The housing sector in many parts remains to be sluggish. We are starting to see inventory rise, so we'll see if that is what that does to both prices and just if it gets some movement. And again, despite how slow the war on inflation seems to be moving, the Fed does believe that they are being restrictive enough with policy to continue to bring it down. So the final piece that I wanted to show that we've been talking about every quarter, again, is just this remaining headwind for a number of banks and the underwater security portfolio values. Obviously the higher interest rates continue to kind of just have this hanging out in front of all of us. You can see the numbers actually kind of ticked up a little bit across the board here in the first quarter. So again, all of this just portends, a little bit trickier environment because you combine again the underwater portfolio with hopefully no additional credit costs, but you could see very quickly how things could become difficult for a bank. And so again, we're just going to continue to monitor those and share those with you each quarter. As we look at the loan growth, again, just getting into the QCBI numbers, again, as we saw loan growth, at the median is still up. Almost 2 out of 3 banks are seeing, 5 to 10% loan growth. 13%, didn't see any loan growth. I'm just gonna. We had a question come in around, Paul, I'm going to just take this one while it came up. Have you heard that regulators are wanting to exclude the investment securities that are underwater from the liquidity calculations? Typically we do. I think they want you to, to look at it, both ways, but certainly push comes to shove. If you're unprepared to sell those at a loss, then they're really of no help to you. So I think you need to certainly, factor in a plan of not counting on those. And the best way to do that is exclude them from your calculations. But you can see again at the median, loan growth was still pretty solid. I think this is an example of where we're going to try to get more data for next quarter. Mike Tierney made a good point, right? For a lot of us, we're not living at the median. And so what we're going to do is kind of expand the horizon here and kind of show some ranges. So again, we're working on that and it should be ready for next quarter's presentation. Deposit growth again at the median, just slightly up, but to the right, you can see 40% of the institutions in the country saw no deposit growth. And obviously most felt for the $0 to $100 million banks, right? So, not surprisingly, again, I think the challenges sometimes for smaller banks are higher. And we're certainly, at least in this particular quarter, or the last 12 months, see this with deposits at the smallest of institutions. Yield on loans at the median increased over the last 12 months. Cost of funds, though, increased at a greater rate, and NIM continues to slide lower at the median. Non-interest income was again lower, not surprisingly, and the efficiency ratio, ticked up pretty in a pretty meaningful way here at the median over the last 12 months. Or excuse me, over the most recent quarter. Pre-tax ROA lower again. You can see kind of the majority of banks are kind of somewhere between that 75 basis points and 150 basis points of ROA. 300 banks again, 0 or negative ROA, pre-tax ROA. And then you can see below core operating earnings dropped as well. Again, still, decent core operating earnings, but certainly well off of where we've been. Right. At this point, I am going to turn the presentation over to David, and he's going to talk through the different concerns around credit and just credit performance. David, I'll give you the screen.
All right, I will do that, and hopefully we can maneuver quickly into my presentation. Hopefully
there it is. I see it. I can.
Super.
Thank you.
Well, as a good transition, now this is usually Sean's bailiwick, obviously with wholesale funding, but I just wanted to show this kind of along the lines of deposit growth in the industry. There does seem to be at least a leveling off of the dependence of wholesale funding. Interesting, as you'll see a few of the charts here, we regionalize quick analytics data as it relates to lending. And you've got here between the northeast and the Southwest being the kind of outliers for dependence on wholesale funding. But again, the primary perception here, of course, is it's leveled off, which is I think certainly good news. In terms of certainly delinquencies, you can see what still seems to be emerging. It's more consumer-oriented credit cards and those types of loans for consumer mortgage type things that are showing some delinquency. Business loans still performing fairly well. As far as the quality trends are concerned, again, these somewhat depict what Sean was relating and frankly what you were reporting in the polling. NPLs are creeping up a bit. The charge-offs, there's the only one significant bump up there was coming from the West banks. These are all banks under $10 billion in assets. But you can see the general trend has been to begin to come off of the bottom of the huge amount of kind of stimulus spending that came through the pandemic. In the more traditional way of looking at the allowance now, we call it the allowance for credit losses to loans. The kind of the bookends are the West at 150 basis points roughly, and then the Northeast at 100 bips in terms of covering their reserves. But herein lies some of my concern around where community banks or the under $10 billion banks have positioned themselves, particularly to heightened regulatory scrutiny for the remainder of 2024. And that is, as you can see, a rather inverse way of looking at this is what are your allowance for credit losses compared to your inventory of acknowledged non-performing loans. And that has tended to drop a little bit. It's not the case if you factor in a lot of the mega banks and larger banks. In other words, their allowances are rising. Community banks marginally declining in proportionality to reserves. But herein lies the real issue that makes, I think, community banks have a little more of a target for regulatory scrutiny is that while larger banks have shed some of their CRE exposure, community banks have increased it. And that is, so the dichotomy between increasing or lowering reserves and increasing exposure to arguably what is the front burner of concern, which is CRE in terms of credit quality, I do think that just puts a little more onus on community banks and frankly our clientele, of course, to be sensitive to that likely increased scrutiny. And speaking of the traditional way of looking at reserves and how we, well, not reserves, but real estate CRE proportionate to your risk-based capital, the chart to the left, of course, is the 100% construction development. Not unsurprisingly, the Southwest and the Southeast lead in those. They tend to be more, Sunbelt states where there is a little more migratory or economic growth going on to justify construction and development lending. As far as the broader 300%, again, that's pretty much the West and the Northeast that are in the higher categories. But I'm going to speak to this in a moment, but these are a bit of the trap that we're seeing being developed here, and that is a lot of the banks just kind of fixate on where they are on the 100 and the 300% guidance, and everything we're hearing in terms of any type of regulatory scrutiny, whether it's a formal order or just critiquing, is that regulators seem to be displeased generally with banks staying at this level of analysis. They want far more granular subset analysis of what's going on beneath these 300, 100 general guidelines. So I do think I'm going to mention a little bit more of that in a moment. Multifamily is of some concern to me. I know that's somewhat contentious out there. Some people don't think that's a big deal. I tend to think multifamily goes in the opposite direction of one to four family. When one to four family is stymied by higher rates as it is right now, the mortgage industry. Multifamily, people flock to multifamilies. The problem with multifamily now, there's been some excellent articles written in the last month or so about they're getting compressed on the top end because in many cases they can't pass rents up much higher. The inherent cost of operating multifamily projects is increasing significantly, and they are further hit from the bottom end in terms of valuations because many of these properties were designed, planned, developed, and financed with lower cap rates, and therefore valuations are beginning to somewhat deteriorate in those. So I would urge people to take a heightened look at multifamily. C&I, again, returned after the large PPP and the much of the C&I activity during the pandemic has really returned to kind of par of what it is under the $10 billion banks. Not unsurprisingly, the Midwest significantly leads in ag and farm loans. Again, these are not farm credit system loans incorporated in this strictly commercial banking. Current landscape is still very good in terms of credit performance. Really, only 11% of the 10 billion and under banks have not net charge-offs, under 10 basis points or over 10 basis points. So that's certainly a positive. You've heard me mention this before, but I really strongly believe that the post-booking servicing and monitoring is the area needing more improvement. And it seems that regulators have hooked into that as well. It's not original underwriting, that's excellent, but it's the post-booking servicing. We're seeing loan demand, and of course, it always is quite regional and local, but there does seem to be, at least in some of the financial press, some indication that bankers have become more encouraged with loan growth. And again, it was interesting to see that in the polling data of the attendees on this webinar. One of the concerns that goes back to the multifamily issue is that this kind of bifurcated consumer we have in the U.S. economy now between the so-called paycheck to paycheck versus the more well-heeled, 401ks, the people, consumers with stronger balance sheets. That stress is obviously continuing to grow. And some of that is not in the formal banking system, but it is clearly almost quarter by quarter, we're seeing increases in delinquencies and stress in consumer portfolios. Small businesses are beginning to feel disproportionate rate pain. And that's, again, one reason why credit takes a much longer time to really process rate shocks and the like, because repricing has to go through the whole process, and that does take some time. I've alluded to this already, but there's no question this is no longer theoretical. It's not a fear that there'd be overreaction by either investors or regulators. It is absolutely here. After the 5 bank failures of 2023, and this is a stark statistic to have to grasp, but those 5 banks basically equated to the FDIC insurance funds 418 failed banks coverage or deposits at risk that they had to deal with, which is of course heightened their sensitivity about preventing future failed banks. But what we're clearly seeing, at least certainly anecdotally from our end, is this is not about going toe-to-toe to chief credit officers about moving this credit or that credit to non-accrual or a major downgrade. It's really all about credit process. You could argue that's low-hanging fruit, but it's clearly evident to us that post those 5 bank failures last year, there is certainly more assertiveness, if not more aggressiveness, among the regulators around, particularly looking at your credit processes. Again, estimates of about $1.5 trillion of CRE pricing alone has got to work its way through the system before the end of next year, which inevitably, of course, will have a drag on debt service coverages to be calculated. Again, I think smaller bank CRE concerns, for the reasons I alluded to a moment ago, are growing. And I do think multifamily is kind of joining office as a subset of CRE in the spotlight of some concern. I'll again use this chart. I've used it a few times before, but it is stark in the sense that it's really, particularly the chart to the right, just shows the significant added exposure that the smaller banks in the U.S. economy have taken on even since the pandemic. And again, that's just creating, we realize that's where the more comforting loan growth would come from. That's where much of the smaller bank lending process focuses on CRE or on real estate generally. But my point there is by taking on so much more exposure, there has inevitably become much more of a target for deeper scrutiny. Again, smaller businesses are beginning to show some of the repricing stress that inevitably is coming through that. So in kind of conclusion, how would we, I wanted to be a little more specific this time about just saying improve your loan review or improve your portfolio analytics or improve your stress testing, but specifically to gear towards CRE. And because, again, we're looking at regulatory scrutiny on your processes around how you analyze your CRE book. And take your eye completely off the 100-300 rules that we talked about. It's really the subsets. It's those subsets that make up those your total portfolio, that they want to know where are your concentrations on those, what are you doing to manage those. And most importantly, instead of just sticking with your kind of insular, internal, traditional credit metrics around whether this borrower or this project is worthwhile or performing as expected, it's really about the getting out of the banking mindset and into the regional or the local mindset of the supply and demand of the markets you're lending into. They really do want far more robust sense of, do you understand the supply and demand of the markets you're lending on real estate in? And there needs to be a tie-in to your more traditional credit metrics of that, which obviously is going to mean you need to avail yourself of more econometric and market data. You've heard this many times, you need to really up the game on understanding your own portfolio, your own DNA, using all forms of portfolio analysis to see that type of these weak spots emerging. One of the things that we strongly recommend is take a look at your policies, particularly in real estate. It is again, trap waiting to be sprung on you, I think, if you're still operating off of decade-old real estate policies. Things like it may have worked for a recovery from the Great Recession, but things like 3-year interest only for real estate loans may be now considered rather liberal in the current environment. So make sure your policies don't create a trap for you in that regard. We're big advocates of using multiple stress modes, portfolio level, loan level, and we even have a loan review concurrent, kind of extrapolatory to capital at risk because of that. Certainly to expand loan, this is not the time at all to use cost of loan review as a reason to work on the efficiency ratio. That would be one of the things I think would bring you. But I also think one of the things that we're seeing in the banks that we know have had some MRAs experience recently is a lot of it's the link or the lack of link to the board, to the strategic and capital plans and your risk appetite statement, and a clear linkage to the top of the house, including the board of directors, around, are they aware of these moving parts on how you're managing your credit risk? Because frankly, in this environment, if it doesn't exist in board minutes, it didn't exist. The conversation didn't even occur. So here's an example of, I'm using in this case, the Atlanta Fed's CRE market index. They've completely redone that, which is far more now of it's got some risk embedded in it. It's no longer just a momentum index of where projects are building. But I was in Missouri just last week speaking at the Missouri Bankers Association, and this is an example of We're encouraging people to start looking at their markets. As you can see, in this case was St. Louis and Cape Girardeau. They have different profiles for different types of subsets of real estate. And this is the type of econometric data that you're going to need to, in my opinion, pair with your more traditional credit metrics to make sure you're seen as being on top of the risk profile of the real estate book of business that you're supervising, so to speak. Again, as we talk, you wouldn't think you'd be listening to me without talking something about loan review. Keep a focus on seasoned reviewers. That's critically important. Embrace the fact loan review is your agent, is a critical first line of defense, and we certainly are big advocates at IntelliCredit that only seasoned loan reviewers have that both qualitative and quantitative understanding of credit risk. Again, embrace, absolutely believe in that early detection equates to fewer losses. And we're very focused on working with clients to have them go ahead and acknowledge. And sometimes with loan review, there's a sense that we almost don't want to know what, we don't want to give a regulator a loaded gun and show some weakness. But I think, again, the fact that you can go through using some of these metrics to really, in effect, ensure a more risk-based sampling in your loan review, I think would actually in the end serve you much more better strategically. And remember, in this current environment since 2020, large impactful problem loans are now expected to be independently reviewed. Again, I alluded to this, that we do a companion kind of capital stress test that's done concurrent to our loan review work. We think that's a great, our reviewers basically recalculate certain kind of key metrics in real time, and then that's extrapolated to the risk-based capital allocated to those loan subsets. And most importantly, you get kind of a top 5 or top 10 list of the credits or borrowers that may indeed be at risk, say if we had significant stress in either the valuation or the repayment categories. I did close, I think, last quarter with this point, and in conclusion of my presentation today, we all know that credit doesn't move even as quickly as the financial press does in terms of where the economy's heading and even rates. Again, this is here to state, remember, even when the Fed stops or halts their rate increases, historically, empirically almost proven is that there's a lag of upwards of 18 to 24 months before problem loans peak. So we've yet to get through that 18 months or 24 months. And so I just would say, you know, keep your eye on that, because and a lot of it is, of course, the repricing that's going through the whole pipeline at this point. So I will stop sharing at this point and hand it back to you, Sean, and thank you all again very, very much. And we always enjoy meeting with you. Sean?
Oh, sorry, I forgot to unmute myself. Going to take a few of these questions here before I put the screen back up. The first one's a good comment. Can you provide a map of what states are included in each region in the future? Yes, we will do that. The question is, we are in Kentucky, not sure if that would be Southeast or Midwest. So yeah, we'll make a little chart to show those.
Yeah, we like that. Kentucky happens to be in what we call the South Central, along with Tennessee, and yeah, fully fair point.
Yeah, that's a good point. Yeah, so we will do that. Another question came in. What are your thoughts on BlackRock's Rick Reeder? The best way for the Federal Reserve to temper inflation will be to lower rates, not hold them higher. Yeah, I think that's an increasingly popular view among economists like Claudia Sahm and Rick Reeder, who's obviously an incredibly capable and knowledgeable individual. So I don't think that's the prevailing wisdom, but I think there's increasingly a lot of sentiment that the Fed will help themselves by cutting sooner rather than later. And so we'll see if that starts to become a more consensus view. Certainly not at the moment. And then the last question is, do you expect extra scrutiny on restaurant loans given the recent public bankruptcies and closings? David, what are your thoughts there?
Well, as a credit guy for ever and ever, restaurants are probably the most difficult for credit to get there. It's always been an issue. Always, it doesn't matter. Go back 40 years, and restaurant loans were always considered, kind of dicey. But yes, I'm certain that it has further added a sense. Although I'm sure not many community banks are heavily involved in some of the major chains, but certainly yes, no question whatsoever about that.
Yeah. Yeah. Thanks for the questions. Keep submitting them. Just a reminder, if you haven't looked at Quick Analytics, we do uncover a number of things, including bank and peer performance, interactive bank pages, and then obviously regulatory tools such as the CECL solver. And I think, again, I think I've said this last quarter, we've gotten more interest in our credit stress test. I think, again, from a portfolio level, it's really a really good way to take that entry level step into stress testing and then follow it up with something at the loan level with David's team in IntelliCredit. Just a reminder of the growth we continue to see in IntelliCredit. We certainly encourage you to look into not only our analytical tool called the Portfolio Analyzer. We have coffee talks on those now every other month, and we are offering complimentary trials to get yourself familiar and see if there's value for you in it. We think there is. But we want you to have the time to make that determination on your own. And then David and his team are always looking and willing to take an RFP for any future loan review that you might be considering. Just a reminder again, the IntelliCredit, really our solution and our service, covers both an analytical tool that you can use with your team. It also has an internal loan review facing application you can use, as well as annual reviews. And then that same tool is what David and the team uses for our reviews that we conduct as an external loan review. I think you really can't under or overemphasize the fact that it is a SaaS product, so there's not a ton of integration. We really just need to get some data from you, and we can kind of bring all your information to life. So certainly welcome any opportunity to show you that in the future. As I mentioned earlier, we are offering a free trial on the analyzer. Again, I think to David's point about looking into subsets and better having granular information about your loan portfolio. I mean, it's really at the heart of what the Portfolio Analyzer does, and really just gives you a very easy way to get at your data.
Well, one thing, if I may interject, Sean, and we obviously spend a lot of time demonstrating this along with the loan review services, but one of the consistent comments that are made, even by people seeing the demo, is that what this can do for me in almost microseconds is what may take days in day-to-day work, because there's not a bit of need to export that to Excel and then reformat it. So it's all done self-contained.
Exactly. And I think that's probably, again, one of the things that I don't emphasize enough is, while this tool is designed to be do-it-yourself, part of the idea of the free trial is we want you to share, reports that you might be creating at the bank today. We'll help you replicate those, hopefully in a much easier way. So to David's point, not only take, and minimize or reduce time taken just to do analysis, but also so, for maybe some of your loan committee or board reports that, takes people time to get information out of the core. We feel like we can really just streamline that entire process for you while improving the quality of the data that you see. And so again, we don't want you to take our word for it. We want you to be able to do it. We're going to work with you within the trial period to again, take those reports that are most important to you and replicate them. And then, hopefully identify additional reporting that you might find helpful now once you can actually see more of your raw data right at your fingertips. So again, reach out to us, info@intellicredit.com or info@quickrate.com. We really would love to demo that for you, or just join one of our future coffee talks on the analyzer. We do have an upcoming coffee talk. Hopefully our friend Paul Allen's going to join us. We're not sure if it's going to be May or June, but we will have one at the end of May. Look for our YouTube channel, again, where we'll post highlight presentations that we're doing. And you can look into historical ones. I don't see any final questions. So David, any final words for everybody before we let them go today?
No, and I'm just excited about sharing this. It won't be months to get up and running on Portfolio Analyzer. We're talking 2 days. So that please call us, because we see this clearly as an affordable and practical solution for community banks to frankly to catch up with some of the mega banks' ability to know what the DNA they're sitting on.
Exactly. Thank you all again for joining us. We really appreciate you taking time to schedule to join for these quarterly reviews. As I mentioned, we hope to have some updated and enhanced reporting and presentations next quarter. But in the interim, if you have any questions, reach out to us at info@quickrate.com, and we will look forward to hopefully seeing you again next quarter. Thanks so much and have a great day. Bye now.